You saved your whole life to have options in retirement. So when it's time to buy a car, you do what feels smart. You pay cash. No monthly payment, no interest, no debt. Clean and simple. Here's the part nobody tells you. That decision, the responsible one, could quietly cost you $3,000 to $4,000 in taxes, jack up your Medicare bill for the next 2 years, and hand the dealership an extra $2,000 in profit they were hoping you'd never figure out. This isn't a video telling you to go into debt. It's a video telling you exactly how the math works, so you can walk into that dealership in control, not confused. Stay with me, because the second half of this video is the part most people never hear. According to the Q3 2025 Hague report, the average finance and insurance department at a publicly traded dealership made $2,534 in gross profit per vehicle. Not from the car itself, from the back office, the finance manager's office. That's the room you walk into after you've already shaken hands on the price. And here's what very few retirees understand. When you say, "I'm paying cash," that number, that $2,534, doesn't disappear. The dealer just finds a different way to get it. And if you pulled that cash out of a 401k or traditional IRA to do it, the IRS may have already taken their cut before you even got to the lot. Section 1. The tax trap nobody warned you about. Let's start with where that cash is coming from. If your savings are in a 401k or traditional IRA, and for most retirees that's exactly where they are, every dollar you pull out is taxed as ordinary income, not at capital gains rates. Ordinary income, same as a paycheck. So let's say you need $35,000 for a car. If you're a married couple in the 22% federal bracket, pulling $35,000 from your IRA means roughly $7,700 in federal taxes before the money even hits your checking account. That's not the car costing $35,000. That's the car costing closer to $42,700 by the time Uncle Sam is done. And that's if the withdrawal doesn't push you into a higher bracket. Here's what makes it worse, and this part is genuinely something most people don't know about. Section 2. IRMAA, the Medicare ambush. IRMAA stands for Income-Related Monthly Adjustment Amount. If your income goes above a certain level in any given year, Medicare charges you more for Part B and Part D, not right away, but 2 years later. That's the trap. Medicare looks back 2 years at your tax return to set your premiums. So if you pull $35,000 from your IRA today to pay cash for a car, that withdrawal shows up as income on this year's tax return. 2 years from now, Medicare uses that number to decide what you owe. In 2026, the IRMAA surcharge kicks in at $109,000 in modified adjusted gross income for a single filer and $218,000 for a married couple. Now, you might be thinking, I'm not anywhere near those numbers. But here's where retirees get blindsided. Your income in retirement isn't just what you choose to withdraw. It's Social Security. It's any pension. It's required minimum distributions if you're 73 or older. It's capital gains from your brokerage. Add all of that together, then add a $35,000 car purchase from your IRA, and some retirees cross the IRMAA threshold without realizing it until Medicare sends them a bill. The standard Medicare Part B premium in 2026 is $202.90 a month. If you cross into the first IRMAA tier, that premium jumps to $289.10 a month. For a married couple, both on Medicare, that's an extra $1,032 per year. And it's not a one-time penalty, it's a monthly surcharge that runs for the entire year your income stays elevated. One car purchase, 2 years of higher Medicare bills. That's the hidden cost of paying cash that nobody at the dealership is going to tell you about, because it's not their job, it's yours to know. If this is making sense, please hit the like button and drop a comment below. I read every single one. Now let's keep going because it gets more interesting from here. Here's where the story shifts. Because what I'm about to show you isn't about going into debt. It's about using the dealership's own system, the one they built to make money off you, to actually work in your favor. There's a specific move that can save you thousands on the car price, keep your tax bill flat, and protect your Medicare premiums. And almost no one walking into a dealership today knows how to use it. Section 3. How the dealer makes money and how to use that against them. When you finance a car through a dealership, the lender, a bank or credit union, offers the dealer a wholesale interest rate called the buy rate. The dealer then marks it up, typically 1 to 2.5%, and quotes you the higher number. The difference is called dealer reserve. The dealer pockets it on every payment you make. You never see it. According to NerdWallet, on a $30,000 5-year loan, even a 1% markup adds about $840 in extra interest you'll never know about unless you go looking. Now here's the thing most people do backward. Cash buyers walk in and announce they're paying cash, thinking that gives them power. It does the opposite. When a dealer knows you're paying cash, they lose all their back-office financing profit. So they become less willing to negotiate on the price of the car itself. According to J.D. Power, the average retailer profit on a new vehicle was about $2,202 as of August 2025. When you finance, the dealer makes money in the F&I office and has more room to discount the car. When you pay cash, they need to make it back on the sticker price. The FTC sent warning letters to 97 auto dealership groups in March 2026 for deceptive pricing and hidden fees. Their largest auto dealer enforcement action ever, a $20 million settlement in late 2024, was over exactly this kind of back-office overcharging. So what's the right move? Section 4. The Smart Retiree Strategy, Step by Step. Here's what works. Step 1. Get pre-approved before you walk in. Go to your bank or credit union first. Get a pre-approved auto loan rate in writing. This does two things. It gives you a real baseline to compare against whatever rate the dealer quotes, and it signals to the dealer that you know what you're doing. If your credit union offers you 5.9% and the dealer quotes you 7.5%, you now know they're marking it up 1.6%. You can push back. Say this: I've been pre-approved by my credit union at 5.9%. Can you beat that? If they can, great. If they can't, use your own financing. Step 2. Don't mention how you're paying until after you've negotiated the price. This is the most important thing I'll say in this video. The price of the car and the payment method are two separate conversations. Negotiate the car price first. Once you have the best number on paper, then discuss how you're paying. Many retirees mix these together, and the dealer controls the whole deal. Keep them separate. You stay in control. Step 3. Consider financing a portion, even if you have the cash. This is where it gets a little counterintuitive. If you finance $20,000 of a $35,000 car, you don't have to pull the full $35,000 from your IRA in 1 year. You pull $15,000, enough for the down payment. That smaller withdrawal may keep you below an IRMAA threshold. It keeps your taxable income lower, and it avoids the bracket bumping problem we talked about earlier. Then, and here's the key, check whether your loan has a prepayment penalty. Most auto loans don't. If yours doesn't, you can make a large extra payment 3 or 4 months later and pay it off early. You get the better negotiated price, you protect your tax situation, and you avoid carrying long-term debt. Step 4. Know the new tax break that runs through 2028. The One Big Beautiful Bill Act, signed in 2025, includes a provision that lets you deduct up to $10,000 per year in auto loan interest on a qualifying new U.S.-made vehicle. This deduction applies from 2025 through 2028 unless Congress extends it. That means for some retirees, financing a qualifying vehicle is now genuinely cheaper after taxes than paying cash. Not marginally cheaper, meaningfully cheaper, depending on your bracket. If you're in the 22% bracket and you're paying $10,000 in annual loan interest, that deduction could save you $2,200 in federal taxes in a single year. That changes the math entirely. Now, let me walk through 3 mistakes I see retirees make in that finance office. Mistake 1, answering, "What monthly payment are you looking for?" The moment you give a number, the dealer controls the deal. They can hit any monthly payment by stretching the loan to 72 or 84 months, which means you pay thousands more in interest over the life of the loan. Never answer that question. Instead, say, "I'm focused on the total price of the vehicle." Mistake 2, buying gap insurance from the dealer. Gap insurance covers the difference between what your car is worth and what you owe if it's totaled. It's a legitimate product, but dealers charge $500 to $1,000 for it. Your own auto insurance company likely offers the same coverage for $20 to $50 a year, which is $100 to $250 over a 5-year loan. Call your insurer before you go to the dealership and ask about gap coverage. Decline the dealer's version. That one step alone can save you $500 to $800. Mistake 3, making any decision in that back office under time pressure. The finance manager is the best paid salesperson in the building. The average F&I manager earned over $150,000 in 2025, according to finance manager training data. They're skilled, they're trained, and their job is to add products to your contract while you're tired and ready to leave. You are never required to buy anything in that office. Every add-on is optional. Every rate is negotiable. Every fee should be questioned. Take your time. Ask for anything you're signing to be explained line by line. Before you buy your next car, here is exactly what I want you to do. Number 1, call your bank or credit union this week and ask about current auto loan rates. Even if you plan to pay cash, get a number. It takes 15 minutes and costs nothing. Number 2, pull up your most recent tax return and add up your income sources, Social Security, any IRA or 401k distributions, pension income, capital gains. Compare that number to the 2026 IRMAA threshold for your filing status. If you're within $30,000 of it, a large car purchase withdrawal could push you over. That's worth knowing before you write a check. Number 3, if you're planning to finance, check whether the vehicle qualifies for the auto loan interest deduction under the One Big Beautiful Bill Act. The car must be new and assembled in the United States. If it qualifies, run the numbers with your tax advisor before deciding how much to put down. Number 4, when you walk into the dealership, do not mention how you're paying until after price negotiation is complete. That's the simplest move you can make, and it costs you nothing. Before you go, one question for you. When you've bought a car in the past, did you pay cash or finance it? And looking back now, do you think you got the best deal? Drop your answer in the comments below. I read every single one, and if you have a specific situation you're trying to figure out, ask me there. I'll do my best to help. The goal of every video on this channel is simple. Give you the real information, not the generic advice you've already heard everywhere else. If that's what you're looking for, subscribe. And if you want to go deeper on how having a pension changes everything in retirement, that video is right here. Thanks for watching. I'll see you in the next one.